You want to own a casino. Neon lights, the sound of slot machines, a gaming floor that never closes, pulling in cash 24 hours a day. It looks like the ultimate business. The math is already tilted in your favor before a single card is dealt. Here's what nobody tells you before you apply for the license. A casino isn't a business built on winning. It's a business built on making sure that over enough time, at enough tables with enough machines, the math simply cannot go against you. And everything expensive about this industry exists to protect that one mathematical guarantee. In retail, in restaurants, in casinos, every cost hits you at once, every month, whether the floor is packed or empty. Rent doesn't care. Payroll doesn't care. The regulator definitely doesn't care. So what actually makes a casino profitable? It's not luck. It's not the neon. It's the tiny guaranteed mathematical edge defended by an enormous amount of infrastructure most people never think about. Let's build the real numbers, starting before a single chip is ever sold. Before you build anything, you need permission. And this is where casinos are unlike almost any other business on this channel. A gaming license isn't a form you fill out. It's a background investigation into your entire financial history, your business partners, and sometimes your extended family, run by a state gaming commission that can take 12 to 24 months to complete. The investigation alone can cost $100,000 to $500,000 in legal and consulting fees, regardless of whether you're approved. The license itself, depending on the jurisdiction, can range from a relatively modest fee for a small card room to tens of millions of dollars for a full commercial casino license in a competitive market. And it doesn't end once you're approved. Annual license renewal fees, ongoing background checks on key employees, and continuous reporting requirements are baked into owning this business permanently. This isn't a cost you pay once and move past. It's rent on your right to exist in this industry, paid every single year for as long as the doors stay open. Miss a compliance deadline, and a regulator can suspend your license before you've earned back a fraction of what it cost to get one. Once you're licensed, now you need a building. A mid-size regional casino, not a mega Las Vegas resort, something closer to what you'd see off a highway exit or riverboat dock, typically costs $20 million to $100 million to build, depending on size and amenities. That includes the gaming floor itself, but also restaurants, parking structures, and often a hotel component, because casinos increasingly need to be destinations, not just gaming rooms, to compete for a customer's entertainment budget. Reinforced flooring for heavy equipment, specialized electrical for thousands of machines running simultaneously, and security infrastructure built into the walls before drywall even goes up. None of this is optional, and none of it is cheap. You're often 90 days into construction before regulators even allow you to install a single slot machine because the building itself has to pass inspection first. Now the actual games. A new slot machine costs $10,000 to $25,000, and a mid-size floor might run 500 to 1,500 of them, $5 million to over $20 million in machines alone. Many operators lease machines instead, splitting revenue with the manufacturer, sometimes 15 to 25% of what that machine earns forever, in exchange for lower upfront cost. The same leasing trade-off you'd see with a forklift or a treadmill, just with a much bigger number attached. Table games need dealers, chips, cards, and specialized furniture. A single blackjack table setup runs $10,000 to $20,000 once you include the felt, the shoe, and the security features built into the chip tray. Multiply that across 20 or 30 tables, and you've added several $100,000 more before a single hand is dealt. None of this equipment wins money by itself. It exists to run the math correctly, millions of times, without a single mistake regulators can catch. A casino floor runs on people constantly. Dealers typically earn $15 to $25 an hour plus tips, but you need enough of them to staff every table across 3 shifts, 7 days a week, because unlike most businesses, a casino floor genuinely never closes. Pit bosses supervise the tables, watching for dealer errors and player behavior that suggests cheating. A role that requires years of floor experience and commands a meaningfully higher salary than a dealer. Cage cashiers handle the actual cash flow, one of the most tightly regulated positions on the floor because of how much money physically moves through their hands. On a mid-sized casino doing $30 million a year in gaming revenue, total labor commonly runs 25 to 35% of that, $7.5 to over $10 million a year before a single utility bill or lease payment. Every one of these roles also requires a background check and a state gaming license of their own, which means your hiring pipeline is slower and more expensive than almost any other industry on this channel. You can't just hire someone and put them on the floor next week. Regulators require comprehensive camera coverage of every table, every machine, and every cash handling point on the floor, commonly called the eye in the sky. Building that system out for a mid-sized casino costs $2 million to $10 million, and it's not optional. You cannot legally open without it. That system also needs staff watching it, around the clock every single day of the year, a surveillance team separate from floor security whose entire job is catching the exact kind of fraud or theft that a casino's cash-heavy environment invites. Add armed security, cash transport to and from the vault, and a physical vault built to a standard most retail businesses never need to think about. And security infrastructure alone can run into the hundreds of thousands annually just to maintain on top of the multi-million-dollar initial build. Here's the actual engine underneath everything you've just heard about. Every single game on the floor has a mathematical edge built into its rules. Roulette runs around a 5% edge, blackjack somewhere between 0.5% and 2% depending on the exact rules and how well the player plays, and slot machines commonly run 4 to 10% or more, programmed directly into the machine's software. That edge doesn't mean the house wins every hand. It means that across thousands and thousands of bets, the math guarantees the casino keeps roughly that percentage of everything wagered, no matter who's playing or how they're playing. A single player can win big on any given night. The house edge only becomes reliable at volume. The same way an insurance company doesn't know which policyholder will file a claim, but knows almost exactly how many will, in total, across enough customers. This is why every other cost on this list exists: the license, the surveillance, the compliance staff. All of it protects the integrity of that tiny mathematical edge, because the moment regulators, or players, doubt that the games are running exactly as programmed, the entire business model collapses. The edge is the whole business. Everything else is the infrastructure required to be trusted enough to keep it. But a guaranteed long-run edge doesn't mean guaranteed short-run results, and this is the part first-time owners consistently underestimate. On any given night, a handful of high-stakes players can win far more than the math would predict, purely from normal statistical variance. The same way a coin can land heads 8 times in a row without the coin being unfair. This is why casinos need a large cash reserve, often called a bankroll, sized well beyond what a typical week of operations requires. A single exceptional night against a high-limit table can cost a casino a meaningful percentage of its expected annual profit, and undercapitalized operators have gone under from a genuinely bad month, not because the math was wrong, but because they didn't have enough reserve to survive the math working exactly as expected over a short enough window. Managing this risk is its own discipline. Setting table limits that cap how much any single hand can cost, spreading exposure across enough tables and machines that no single outcome threatens solvency, and in some cases, buying reinsurance-style coverage against catastrophic single-session losses at high-limit tables. The house edge is real. It just doesn't arrive on a predictable schedule, and the businesses that fail in this industry are often the ones that ran the average case math and forgot to plan for the bad week. Casinos give away an enormous amount for free. Rooms, meals, drinks, sometimes cash back through loyalty programs, and none of it is charity. It's customer acquisition cost, calculated against something called theoretical win. The amount a player is mathematically expected to lose based on their average bet size and time at the table. A high roller with a large theoretical win might receive a free suite, flights and meals worth thousands of dollars, because that comp package still costs the casino a fraction of what the house edge is expected to earn from that player's play over the visit. It's the same logic as a gym offering a free trainer consultation to a new member. The giveaway is cheap relative to the lifetime value it's designed to protect. Loyalty programs formalize this at scale for every player, not just high rollers, tracking play through a rewards card to calculate exactly how much comp value each guest has earned. Total comps and marketing commonly run 8 to 15% of gaming revenue for a well-run casino, a real cost, but one calculated with the same mathematical precision as the house edge itself, not given away on instinct. Beyond the license itself, ongoing compliance is its own permanent department. Anti-money laundering requirements mean every large cash transaction has to be tracked, reported, and in some cases flagged directly to federal regulators, requiring dedicated compliance staff and specialized software most other industries never touch. Mandatory audits, both internal and from the Gaming Commission, happen regularly and unannounced, and failing one can mean fines running into the millions or a suspended license while the issue is resolved. A mid-sized casino commonly spends $500,000 to $2 million a year on compliance staff, software, and audit preparation alone. A cost with no ceiling, because regulatory requirements only tend to increase over time, never shrink. Insurance on a cash-heavy, high-liability business like this runs far higher than almost anywhere else on this channel. Property and liability coverage for a mid-sized casino commonly runs several $100,000 a year. And that's before cash-in-transit insurance covering the physical movement of money to and from the vault, and fidelity bonds covering the risk of employee theft in a business where employees routinely handle enormous sums of cash. Total insurance costs for a mid-size operation frequently land between $500,000 and $1.5 million annually, a number that climbs quickly after any claims history, the same pattern you'd see with a gym's liability coverage, just with several more zeros attached. Added up for a mid-size casino doing $30 million a year in gaming revenue. Labor, $8 million. Comps and marketing, $3 million. Compliance, $1 million. Insurance, $750,000, surveillance and security operations, $500,000. Equipment leasing and maintenance, $2 million. Utilities and building maintenance on a facility this size, another $2 million. Total operating costs before gaming taxes often land between $17 and $18 million a year against that $30 million in gaming revenue. And we haven't even gotten to the single largest line item on this entire list yet. Unlike almost any other business, casinos pay a direct tax on gross gaming revenue, not profit revenue. And the rate varies enormously by jurisdiction, from single digits in some states to well over 40% in others, particularly for slot-only operations in certain markets. On that $30 million in gaming revenue, a mid-range tax rate around 20% means $6 million a year straight to the state, calculated before you've covered a single operating expense from the list you just heard. Combine that with the 17 to 18 million in operating costs, and a casino generating 30 million in gaming revenue might net somewhere between $4 and $6 million. A real margin, but one earned only after clearing two enormous, mostly fixed obstacles: operations and taxation, in that order. And here's a competitive pressure unique to this industry. Tribal casinos, operating under sovereign nation status, often face a meaningfully different regulatory and tax structure than commercial operators in the same state, which can give them a structural cost advantage on the exact same games in the exact same region. That doesn't mean commercial casinos can't compete. Many do. On amenities, location, and entertainment offerings tribal properties may not match, but it does mean the tax and margin conversation from earlier is sometimes happening against a competitor with a fundamentally different cost structure, not just a different marketing budget. And there's a newer threat that didn't exist 20 years ago: legalized online sports betting and iGaming apps, letting someone gamble from their couch without ever driving to a physical floor. A meaningful and growing share of gambling spending, especially from younger demographics, now happens entirely on a phone, competing directly with the physical floor for the exact same entertainment dollar. This hasn't emptied casino floors, but it has changed who walks through the door and why. Increasingly, the physical casino has to offer something an app fundamentally cannot: live dealers, in-person atmosphere, dining, entertainment, and the specific experience of being there, because on pure convenience, a phone in someone's pocket will always win. Even with a strong location and a loyal player base, margins get squeezed constantly. Labor costs in this industry have climbed as dealer and floor staff wages rise across the hospitality sector broadly, and unlike many businesses, you can't simply automate away a blackjack dealer without changing the entire experience players are paying for. Comp costs tend to escalate over time too, as competition for the same pool of frequent players intensifies. If a competitor down the road offers a better loyalty program, matching it becomes the cost of staying competitive, not an optional upgrade. Compliance costs only tend to increase, never decrease, as regulators respond to new fraud patterns or anti-money laundering concerns industry-wide. And gaming tax rates, set by state legislatures, can change with a single vote, sometimes with very little advance notice to operators who built their entire financial model around the previous rate. The average mid-size commercial casino operates on a net margin in the mid to high single digits once every cost on this list is accounted for. The wider margin from earlier assumes a well-run year, strong compliance, and no unexpected tax changes. Not a guarantee. This is why so many independent casino ventures never make it past their first license renewal. It's rarely the games themselves or a bad location on its own. It's usually a licensing process that burned through capital reserves before the doors even opened, an underestimated compliance budget once real regulatory scrutiny began, or a nearby tribal property with a structural cost advantage that an independent operator simply couldn't outmarket. The operators who survive tend to share one trait. They budgeted for the licensing and compliance timeline realistically from the very beginning, instead of treating it as a formality standing between them and opening day. So some owners take a different route, bringing in an established casino management company instead of running the operation entirely independently. This typically means the owner still holds the license and the building, but a management company runs day-to-day operations in exchange for a management fee. Commonly 2 to 5% of gross revenue, plus an incentive fee, often 10 to 20% of profit above an agreed threshold. In exchange, the owner gains access to an established loyalty database of existing players, negotiated relationships with equipment vendors and regulators, and proven compliance systems built from running other properties. That access to an existing player database matters more in this business than almost any other on this channel. A management company with an established loyalty program can market to thousands of proven gamblers on day one, instead of an independent property spending years building that same list of players from zero, one comp at a time. So why give up that percentage of revenue and profit for less independence? Because in this industry, the two hardest problems, building a loyal player base and staying flawlessly compliant with regulators, are exactly the two things a management company has already solved at scale. That system is a form of insurance against the single biggest risk in this entire business, a compliance failure severe enough to threaten the license itself. A management company with a track record across multiple properties has already built the internal controls and audit processes that keep a casino not just profitable, but licensed to keep operating at all, which in this industry is the actual foundation everything else sits on. Properties under experienced management tend to survive regulatory scrutiny and market swings at meaningfully higher rates than fully independent operations, largely because the hardest lessons in this business have already been paid for by someone else's earlier mistakes at a different property, years before yours ever opened. So the real decision isn't casino or no casino. It's this: operate independently and keep full control over every decision on the floor, accepting the real risk of undercapitalized compliance and a player base you're building entirely from scratch. Or bring in a management company, give up a real percentage of revenue and profit permanently, and gain compliance systems and a loyal player base that would otherwise take years and significant risk to build alone. Neither path removes the risk. One trades, can I stay compliant and build a player base before my reserves run out? For, can I afford the fees? While a system that's already protected other licenses handles both of those problems for me. The dream was never really the neon or the slot machines. The real product in this industry is trust. Trust from regulators that the games are running exactly as licensed. And trust from players that the odds are exactly what the machine claims, protected by a mathematical edge that only works if nobody has a reason to doubt it. Whether you build that trust yourself from a brand new license, or pay a management company for a system where that trust is already established across other properties, The games were always the easy part. The compliance was the real business. So why does anyone still pursue this, knowing everything you just heard? Because for the operators who treat this like the regulated, mathematically precise business it actually is, not a glamorous shortcut to easy money. The returns can be real, and the entertainment business underneath the compliance is one some owners are genuinely drawn to. They budget the license and compliance timeline honestly from day one. They capitalize their bankroll for the bad month, not just the average one. And they treat every regulatory relationship as something to protect, not tolerate. The operators who last know one number cold: their required reserve against variance, the exact amount that has to sit untouched no matter how good business looks in a strong quarter. They're not hoping the house edge protects them. They already ran the math on how bad a bad week can get and made sure they could survive it before they ever opened the doors.